Hey everybody, Signet here with the Bullish Bears. I want to introduce you to video 4 of building a trading plan. In this video we're going to talk about your trading time plan. So on the time frame that you trade, it's very critical. And before I get into that, I want to make sure that you understand that there are other videos in this series. So I started out with a pretty good background video on what we were going to try to accomplish, covering all of these things here that you see on this list. And since that first video, I've made one strictly on account sizes and then on your trade goal. Now we're covering trading time frame. Now this isn't time in the trade, that will be in the next video. This is what charts you're using in your strategy, what time frame are on your charts, right? And that doesn't have to necessarily be time either. It could be a tick chart. But we need to determine and establish what time frame you're trading in or what you're using when you're looking at your charts. I don't know how a Renko chart works because I don't have that in Thinkorswim, but I've seen them. I don't use them. But you could be trading Renko, monkey bars, you could be trading tick charts or time-based charts like a 5-minute chart or a 1-day chart, a 5-hour chart, whatever it is that you're trading. It needs to fit your trading goal. Developing some very strict rules when it comes to the time frame you're trading can make or break your strategy. The reason for this is I think a lot of traders completely ignore the higher time frame, and that's a mistake no matter what you're trading or how you're trading it. I'll give you some really great examples. When you start getting into a monthly chart and a weekly chart, you really get an opportunity to identify various price structures that could impede your price movement. You might not even know that there's something there that price could hit if you had not gone to the higher time frame and identified where those levels could be. So here for an example on 3M, you can see that we've got various price structures, pivot points where prices ran up, hit something, and pulled back, found some support, and ran back again. These areas are where price could get hung up. It's where price could reverse, stall, pivot. You can find those areas and lay them out really nice with Fibonacci, or just by going in and drawing out your trend lines, identifying those various levels of support and resistance. Price will interact with its previous areas. This gives you a great opportunity to identify where price could get hung up. And, you might decide not to take a trade when you go into a higher time frame and you start drawing out some angular support and resistance and recognize that price is getting ready to hit an area that you're about to take a trade in. Meaning you might think you could get a good $5 move, and then you get onto the higher time frame and realize, oh wait, there's angular resistance overhead. This probably won't go more than $1.50 before it hits that. There's no way I'll hit my $5 goal, or there's a low probability that I would hit my goal, and then you might decide not to take the trade. But when it comes to pulling the trigger, once the trade has been established and you know that you're ready to go, you still need to have a time frame in mind for what you're going to trade on. I take swing trades a lot based on the daily charts. Once I've decided to take the trade based on my analysis, I don't need to go in and look at a 5-minute chart or a 15-minute chart to determine my best entry. Now, if it's important enough, or if I think that there's some value in it, I will go look at those time frames just to see if there's anything that I might be missing support-wise. But most of my swing trades are developed based on the monthly, weekly, daily, 4-hour, 2-hour time frames, and I'll analyze all of those. I won't spend all day looking it over, but I would definitely go in, look at it, and determine if there's any issues or any support and resistance that could get in the way. Throw some moving averages up, some higher time frame moving averages, and really analyze what could stop my trade from getting to where it needs to go. So when you're trading, you're building your trade strategy or your trading plan, you need to determine what time frames are going to be appropriate for you and always use them for that strategy. Now, like I said, I trade after I analyze 5 different time frames. That's my rule for my swing trades. I don't do that, on my intraday futures trading. I've already got those charts lined out, and all of those higher time frames have already been established. I don't waste my time at that point. I already have everything that I need. But your trade time frame is critical. You have to take the opportunity to choose what is appropriate and then build your charts out matching that time frame. One thing to recognize, like the indicators that we have on Thinkorswim, implied volatility indicator doesn't do any good once you leave the daily chart, right? Because normally when we're looking at implied volatility, especially if we're calculating rank, once you leave the daily chart, the implied volatility is no longer a year calculation. So the time frame really matters, especially depending on the type of strategy that you're going to trade. Intra-week butterflies, you might want to identify the various price structures and price levels on a 4-hour or a 2-hour chart, but you have to have these data points written down. You have to know what time frames are appropriate, and not only which ones are appropriate, but which ones do you not want to use, right? This logic and this criteria matters a lot. It matters when it comes to scanning for your trades. It matters when you're developing the analysis to pull the trigger. Taking the time and the opportunity to very specifically write down and determine what time frame you want to use is critical. I know it seems very simple, very basic, like, oh well, it doesn't matter. I'll just look at these time frames. It's what I always do. I don't need to put that into the plan. You really should take that opportunity to put it into the plan. Time frames also deal with dividend, ex-dividend, earnings announcements. All of those are time-based. FOMC meetings and any other binary events that can come out, time-based. If depending on how you have your charts set up, you might not see that there's an earnings announcement. You might not know that there's something right around the corner that could whack your trade that you never saw coming, especially ex-dividend. That gets by people all the time, right? So taking that opportunity to dial in your time frame is really critical. When you're going through your time frames, doing your analysis, that's an important time frame to it's an important time to start drawing out those levels. Price has a habit of seeking the same areas, and you want to take the opportunity to mark those areas so that you can find them on all of your time frames, and you can save those in a drawing set so that it doesn't have to stay on your charts. You can take them off of the default and have them saved on their own level so that when you're normally flipping through the chart, you won't see these lines and drawings all over the place, but they would be there just by swapping over to the layer that you have them saved on. Some indicators work differently depending on how much time is on your chart. An example of that is the regression tools. So if you're using any kind of linear tools or the regression tools, these can really act differently depending on what time frame you're on, and it can really mess up your analysis. So here, for an example, most of these will drastically change depending on the time frame that you're showing. Not just if you're on a 5-minute chart, for an example, but if you're on a 5-minute chart with 2 days or a 5-minute chart with 10 days, right? It matters, and it will change where this line is drawn. I'll give you an example of this. Here is a 5-day, 5-minute chart, and you can see that it's coming right into this area here. Now I'm going to leave it on 5 minutes, but I'm going to change the days. And now you can see it's no longer going through this area. Now it's going through this area. All right, that might not seem like much, but it can be the make or break moment that could define whether you take a win or a loss. And this is only one example. There are many different indicators that are affected by how much time is showing on the chart, like the price channel or the standard deviation channel. This does not know anything other than how much time back it's calculating. So the time frame matters, but the time showing matters also. So this isn't just, me wanting to make another video and keep you occupied and entertained. This is an important aspect that you really need to grasp and comprehend. Your analysis can be completely thrown off if you're on the wrong time frame with the wrong indicators. So it is important that you recognize and understand what time frame you're trading and what your goal is, right? Implied volatility, like I was saying, if you're looking to do premium trades, you don't want to know the volatility, the implied volatility on a 4-hour chart. That doesn't do you any good, right? So just take that time and that opportunity to make it a part of your plan. What time frame are you trading? Maybe you're doing an intraday trade. Maybe your strategy is all intraday trading. So at that point, are you using an anchor signal chart, or are you only trading on a single time frame? If you are you trading a 2-minute? Are you trading a tick chart? Is the market that you're looking at something that can even be viewed on a tick chart? These are important questions that need to be answered, and it needs to be a part of your trading strategy. If you're trading a 2-minute strategy, stay on the 2-minute. If you're trading a tick chart, stay on the tick chart, right? Make it a part of your plan and build some structure into your system. So that is really all that needs to be said on time frames. I think we've covered just about as much as we can cover on this. It is very critical, and it needs to be determined. It needs to be defined so that you don't change arbitrarily, just jumping through time frames, whatever suits you. Make it a part of your trading plan. I appreciate you watching this video, and I look forward to seeing you at the next one.